Imagine looking down at a modern economy. You'd see thousands of companies operating at once, factories expanding, and millions of shares changing hands every second. With so many individual prices fluctuating simultaneously, answering a basic question like, is the market up, becomes a massive data problem. Some stocks fall while others rise. To make sense of it all, financial engineers created the stock market index. It acts as a mathematical benchmark, a single trackable number representing a specific portfolio of securities to capture the overall behavior of the market. You can see this math in action on the live ticker outside the Bombay Stock Exchange. That scrolling Sensex number calculates the market's aggregate health. The index takes the noise of millions of individual trades and distills them into one clear, readable signal. But compressing dozens of companies into a single number requires strict rules. A telecom giant and a mid-sized auto manufacturer aren't given the same level of influence in the final calculation. In the market capitalization method, block size equals shares times stock price. Larger companies carry heavier weights. But watch them shed outer layers. The free float method strips away locked corporate shares, resizing blocks to count only equity available for public trading. There are alternative methods. The Dow Jones uses a price-weighted system, where higher-priced stocks have more influence regardless of company size. Others use an equal-weighted approach, which requires fund managers to constantly buy and sell shares to maintain the exact same percentage for every company as prices shift. The mathematical weighting method dictates exactly which version of the market you are looking at, directly influencing the final benchmark number. Beyond the math of weighting, a reliable index must balance two physical realities of trading: diversification and liquidity. Because individual companies are hit by unique shocks, like a factory fire or a bad CEO, grouping different stocks together allows these specific risks to cancel each other out. This effect is most potent early on. Moving from 10 to 20 stocks cuts risk significantly, but once you reach 100, the mathematical benefit of adding more companies effectively vanishes. Then there is liquidity, which comes with hidden expenses. The gap between the highest price a buyer will pay and the lowest a seller will accept is called the bid-ask spread. When institutions execute massive trades, they face an additional penalty known as impact cost. Looking at this order book, you can see impact cost happen. A massive buy order quickly consumes all the shares available at the ideal price. To fill the rest of the order, the buyer is forced to move up into higher price tiers, degrading their average purchase price. To manage these variables, independent organizations, like NSE Indices Limited, operating here at the National Stock Exchange, act as guardians. Their specialized committees rigorously enforce inclusion rules and adjust the math for corporate actions, like stock splits or mergers. These rigid inclusion rules ensure the index reflects only the most vibrant, highly tradable securities, keeping illiquid deadweight out of the calculation. The function of the index shifted when investment firms realized they didn't just have to watch the benchmark, they could replicate it. This realization led to the index fund. Instead of trying to guess which individual stocks will win, these mutual funds use the index as a precise blueprint. They buy the exact same stocks in the same proportions, locking in returns that mirror the market average. Exchange-traded funds, or ETFs, take this a step further. They bundle the entire index into a single tradable asset. Investors can buy or sell this basket of stocks on the exchange dynamically at any point during the trading day. Institutional investors also use index derivatives, specifically futures and options. These contracts use the index itself as the underlying asset, providing a mechanism to hedge portfolios against broad market downturns. By organizing thousands of price movements into a single path, the index allows anyone to navigate and own a slice of the entire economy.